Hi, I'm Shiloh Bates, and welcome to the CLO Investor Podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. The views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates.
Today I'm speaking with Sam Garza, a portfolio manager at DoubleLine, where he oversees macro asset allocation and the CLO team. We discuss return premiums and CLO debt, captive CLO equity funds, software loans, and newly proposed rating criteria changes for CLO debt, which could lower the amount of equity subordination required for a given rating. Some housekeeping items: I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And if you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Sam Garza. Sam, thanks for coming on the podcast.
Thank you for having me, Shiloh.
So how did you end up in the CLO business?
Well, I've been on the buy side since 2000. I originally started at TCW on the agency mortgage desk, and then we started a credit structure product team, which I quickly joined a couple of years later. At one point early on, this is going back 25 years, I was the only one that knew how to use Intex. And through a series of events, believe it or not, our first CLO mandate was a CLO equity fund. And the existing portfolio manager ended up leaving. Everyone was pointing at me knowing Intex and having some understanding of CLOs. So I ended up managing a CLO equity fund starting in around 2003 until the time we left TCW in 2009. I guess I was inserted directly into the hot seat from day one and have been involved in the CLO market for 25 years almost now.
So a CLO equity fund from 2003 to 2009. So my intuition is that the returns would have been pretty tough. You would have had to keep the fund going probably through 2012 or 13 to really see like the full recovery from the GFC, or what was the experience?
Yeah, that's right. And to make it even more interesting, there was a limit on how many, I said CLO equity fund, I should have said CDO equity fund. We were capped at 70% CLOs, and the other 30% had to be other CDO vehicles. So we had to buy ABS CDOs. Everyone knows the story there. CRE CLOs, at that point, CRE CLOs. And so everything was going as planned until about 2006 and then to 2007. And we had one client. One client was the investor. And I ended up having to meet with them quarterly during the 2008 through 2009 time period and giving the updates. There was a lot of downward volatility, to say the least.
So did you move from TCW to DoubleLine, or?
That's right. Came over pretty much right out of the gate. DoubleLine was founded in the late December 2009, early 2010, depending on how you want to look at it. I came over right away, joined, and have been a portfolio manager ever since.
So what do you find interesting about CLOs?
Well, the track record of, which I'm sure we'll get into, of defaults and whatnot sort of speaks for itself. But after the GFC, there was a lot of discussion about the difference between CLOs and CDOs. And in terms of being a structured product, CLOs, the underlying collateral being bank loans, having high recovery rates, it gives investors the opportunity to invest in a credit product without interest rate duration. And it's well structured. There's a track record going back 25 years. So I think if you are an investor looking for credit exposure and you do or don't want interest rate duration mixed in, there's few places to get. Take your pick. Do you want AAAs or do you want to get a higher yield and go down the capital structure? So I think CLOs offer investors a pretty direct way to get credit exposure. We've got this long track record, as I mentioned.
So at DoubleLine, you're both an investor in CLOs and also a CLO manager?
That's right. My team is the tranche side investor. The way I think about it is we focus on the liabilities, and we have a credit team that is more focused on managing the deals and managing the underlying collateral. When We do deals together. My side is very focused with the bankers and thinking about the liability side and the structure, the documents. And so it's very much of a collaboration, but our focus is specifically on investing in the tranches.
And what tranches are you guys focused on?
We have about $6 billion of CLO investments up and down the capital structure from AAAs down to equity. We don't have a standalone CLO mandate. We use CLOs across, at this point, 90 accounts. Across all of our diversified strategies almost, we use CLOs in various ways. And our exposure somewhat mirrors the capital structure of a CLO. About 2/3 is AAAs and so on.
If it's not a CLO specific mandate, why like the focus on AAAs? I mean, why not come down the capital structure or the cap stack and look for kind of higher yields than the AAA?
Couple ways to think about it. One is a longer term view and one is the relative value, which I'll talk about after. Some of the funds are just short duration oriented. AAAs are more appropriate there. That fund might have invested in treasuries and investment grade credit. And so being well up in the capital structure with very liquid product that we can buy hundreds of millions at a time or sell is very useful and appropriate for those strategies. And then we have the more current view, and I see a fairly flat credit curve, meaning the spread that you get in the lower rate sectors like double Bs and triple Bs is thinner. I think of AAAs as actually looking pretty interesting right now, just from a relative value standpoint.
It would seem like AAAs would comp very well versus anything else that has like a similar rating.
Yeah, absolutely. The spread of, call it 120 within AAAs compared to, call it the IG, the investment grade index at about 80 comps very well. If you look at mortgages, depending on how you run your prepayment spreads, it could be at any given day between like sort of 90 and 120. With mortgages, you take on a lot of duration or other types of risk. So CLOs, even though when you look at spreads relative to its own history, it's on the tighter end of the decile range, it still comps well. And in this world post-COVID of higher inflation and higher Fed funds rate and all of that, I think CLOs stand out even more so.
So if you buy broadly syndicated CLO AAAs in the primary, like you were saying, the spread is like SOFR plus 120 bips. And if you comp that to investment grade corporates, some of which in that index might not or wouldn't be actually AAA, you said that's at 80 bips. Are investors giving something up, or what's the trade-off to get that 40 bips of incremental spread?
This is my personal view here. This matters a lot less these days where there's a lot more knowledge about CLOs. There's a lot more teams, a lot more investors that a corporate bond just makes a lot of sense. Like it's easy to grasp. CLOs are a little bit more complex. It requires a little bit more expertise. It's less and less year by year with the proliferation of ETFs and other investors becoming quite aware of CLOs. Some of it is the complexity of buying CLOs. CLOs are not in the indices, so it's sort of like an off index. If you have a core mandate, you probably want duration. Corporate bonds are bread and butter along with treasuries. So the combination of being floating rate, being a structure, having a more complicated asset, I should say, with a manager who manages underlying collateral, things can sort of change. I think all of that is the premium that you get versus buying corporates. And it's been shrinking over time. I mean, just sort of like as an asset class now being $1 trillion. But those are some of the things I think that lead to that premium.
In the AAA part of the capital structure, do you like the biggest managers with the best track record to get kind of the best AAA pricing, or do you like some of the more emerging managers where you might be able to pick up some incremental basis points on spread?
The simple answer is it depends. It depends on the premium that you get for moving from a well-known tier one manager to an emerging manager. There are times where it's a no-brainer because you can earn whatever we deem appropriate, let's say 10, 15 basis points more for buying an emerging manager. And there are times where all of the manager spreads are compressed together and it's only a couple of basis points, or maybe not a couple of basis points, but 4 or 5. When the manager tiering spread differential is very compressed, we'll tend to focus on tier one managers. When things get a little more dicey, we'll certainly look at the lower tier emerging managers. We have a whole manager ranking process. We look at that and talk about that monthly, and that really informs our view.
And so having a separate CLO management team in-house, I mean, how do you kind of work with them or take their knowledge of the underlying loan portfolios and incorporate that, if at all, in your process?
That for us is really important. They sit right across from us on the desk. We don't usually need to talk to them about like the middle 60% of portfolio, 60, 70% of portfolios of deals that we're looking at. It's really helpful to be able to talk with them when things get dicey. When you look at a portfolio and there's tail risk, whether it's the triple C or the more lower dollar price underlying loans. So it's really helpful to sort of tap into their knowledge base about credit. And then when we do work on things like software, which has been topical, or energy in 2016, or retail, it's really helpful during cycles to be able to talk to them. There's 3 members on the team here, and one of them sits in on their credit meetings and really understands how they're thinking about credit and where they're seeing issues.
Do you buy the CLO debt in deals where you guys are also the manager?
We're restricted across almost all funds. There's a couple funds that we manage where we can do it, where it's understood by the investor, but that's very limited. In general, we're pretty restricted from investing in related entities.
So my focus at FlyRock is really CLO double Bs and equity. And I think double Bs have had a really good go, and higher for longer is going to be another favorable market force that leads to more income from the double Bs. But equity for the last, call it 2 years, has had pretty tough go. Is that the experience you guys have had in your equity investments?
Absolutely. I think we can see it in the data that gets aggregated from time to time that CLO equity has had a rough couple of years. The way that I think about equity, I think the best time to buy is when bank loan prices are low and you can really get a leverage return on that upside. And as we know, over the last couple of years, arbitrage in CLO has been really challenging. And I attribute a big part of that to the whole change in structure of the CLO equity market from CUSIP driven, which was very arbitrage sensitive, to this fund structure that we're in now that is sort of left over from risk retention. We haven't really made any equity investments in a number of years. We've sort of just been letting that run off. And if and when the opportunity comes up in the future, we'll be ready to start looking again.
So this is something I've commented on quite a bit and put a white paper out, but it's the captive fund issuance, has been very negative for the market, especially for equity, because it's just too much demand for loans, too much CLO creation for deals that shouldn't exist, the inability to buy loans at discounts or good loans at discounts. I mean, is there any reason to think that the market structure will change and that there will be less captive CLO equity fund issuance and more economic driven issuance, which would come from investors like you or myself?
I don't think that's going to change until the time where the returns in these funds start becoming very transparent. Investors can look at that and say, well, locked up my money for 10 years and the returns were so. I think we have to go through this whole cycle. As you sort of suggested, for me, it's been frustrating. We were far more active in CUSIPs investing in individual CLO equity, and we've kind of left that by the wayside for now. But I think we need to see the returns of these funds to really see a shift. Institutional investors become very comfortable with these type of funds, and I see them proliferate. It's probably going to be a while before we see a change, unfortunately.
Do you think that the captive equity fund investors have transparency into the marks in these portfolios? I'm asking because it seems like they like their fund investments and it seems like they continue to allocate. So in my view is that the returns could not possibly warrant their capital. So what's kind of the disconnect here?
I don't know the answer to that directly. If I speculate, I think there's a mix of that, and these funds are getting a share of manager fees. And I think that's helping. Investors have probably been told to, wait for volatility and we'll get these moments over the life of the fund. And that's really, as I mentioned earlier, that's really when the opportunities come up. As when and if we see discounts in bank loans, maybe the idea is if you stay in this fund long enough, it'll do okay. And then when the opportunity pops up, you'll already be set. As a sidebar, I remember back in 2016, we had a moment around the energy crisis where double Bs got down to 60 cents on the dollar. And we had a lot of inbound investor calls that wanted to set up investments. And that opportunity was so short, you needed to already be up and running to take advantage of it. And so I guess for investors in these funds, maybe that's part of the thinking.
One of the things that your firm's been in the news for is a negative opinion on private credit. Is that from the top of the house, or is that the firm-wide view? Or
it's our CIO, Jeffrey Gunlock's view for sure. And we talk about it a lot. When I was running the fund back pre-crisis that I mentioned earlier, we had broadly syndicated and we had some middle market transactions. And initially, I was patting myself on the back for having bought middle market deals because they were looking like they were doing pretty well as our broadly syndicated deals were starting to trip tests and we were getting what we could of the NAV data at that time that things were trending down. And then what happened as the crisis evolved was those middle market deals, just came in 1 month and the entire deal had been downgraded. They had like massive downgrades within the portfolio. And my experience of that period was that you can truck along. And because it's not mark to market, you think things are fine. And then only when things are bad enough, it sort of happens all at once. And when I think about CLOs today, we still have not, here at DoubleLine invested in a middle market, well, now private credit CLO. And that was largely born of my thought process from that period. And it was well before private credit became more of a focus in the last few years. I don't really feel like the premium is worth it. Maybe in a downdraft, we'll take a closer look. The last thing I'll add is it's really helpful to be able to go talk to our credit team, which I mentioned earlier, about broadly syndicated loans. And if it's middle market, we're all focused on the manager and you have to have that relationship with the manager and you're really reliant on what the information they give you instead of being able to do that level of research directly for us.
so at AAA, I think the premium for private credit is about 40 bips. So it's like 120 bips over SOFR for new issue broadly syndicated and 160 bips for private credit. So are you saying that's probably too tight to tempt your interest? Either way, none of these have ever defaulted, right?
Yeah. When you think about CLOs in general, there's the default risk and then there's the volatility and the how far might the prices go down during a downdraft. And I would readily acknowledge that AAA private credit deals, they're very unlikely to see a default. It's really for us about the potential for the volatility to move prices down a lot. And during a cycle of volatility, that paper will be harder to move. So we want to be buyers to the extent that we become involved when we see really good pricing. And again, it goes back to being able to understand. We have a whole process for looking at broadly syndicated deals. It involves the collateral, the manager, and looking at the deal structure. In the middle market deals, we can't really look at the collateral, as I mentioned. So it's probably worth it for some investors. For us, we're sticking to our knitting. And when if the opportunity comes up, we'll take a deeper look.
Let me give you two reasons why we like private credit for equity. One is just simply that, each CLO has its own inherent profitability, which is just what's the, spread on the assets when compared to the borrowing cost plus management fee. In private credit, it's just higher than broadly syndicated. And the reason is the spread on the assets is probably almost 200 bips wider. You give some of that up in terms of your financing cost, but you get to keep a lot of it. So just even if the private credit loans and the broadly syndicated loans perform the same in terms of loss rate, you'd be better off in private credit because you just have the distributions are just greater each quarter. That's just kind of true. I think that's just kind of like you run Intex, and I think most people would kind of come to that conclusion. But then the other thing is that the reason I like private credit is docs. In broadly syndicated, as you know, there's this whole industry of lawyers who have found ways to kind of Swiss cheese credit agreements, put in little trapdoors and all kinds of ways to take collateral that you think is pledged to you and maybe find out that it's not, or not in the way that you'd like. And in private credit, I'm definitely not going to say the docs are perfect, but the standard private credit doc is that you can't really do anything. You can't move assets to any unrestricted subsidiary. There are no kind of baskets or builder baskets like you have in broadly syndicated, where every quarter that goes by, you have more flexibility in terms of what you can do that might work against the lenders. So I get your point. Like, okay, if you look at a private credit CLO, you might find 100 names in there, 100 borrowers, and your team might not know any of them. I could see that as a stumbling point. But on the other hand, the profitability is better, the docs are better, and the manager probably has like a decade plus kind of go at managing these loans. So you add all that up and it seems kind of compelling to me.
I can also see your point. For us, it's really fundamental that we're able to reverse engineer that. And that goes for all of structured products. We have teams here focused on commercial real estate, ABS, mortgages, and in all areas, we're very focused on understanding the collateral pool and being able to understand it when things go bad. And I'm sitting in the fixed income asset allocation committee and talking about the deals and knowing private credit equity may end up compounding at a higher rate, even through a cycle. And for us, it's important that we're sort of able to have a process and talk to investors and our own internal peers about what's happening in that portfolio. So maybe it's an opportunity we miss out, but it's something that really works for us and we'll sort of stick with it. We think broadly syndicated CLOs are a fantastic and big enough space on its own to generate returns that make sense for our portfolios.
Coming back to equity for a second. So we're talking about how the captive equity funds, they dominate the primary market and have left all of CLO equity just a little less profitable than it's been in the past, given those kind of dynamics. But if you look at buying secondary equity in an auction process or from a dealer, the returns would probably model out like if you use, a 2% default rate and a 70% recovery rate, in your modeling assumptions, you'd probably find mid-teen kind of returns. So even there, is that not of interest to go do some more work and see if it would fit in your funds?
I think this will be a point of difference here. We run our recovery rates lower as a starting point, and we're seeing it bear out in some of the aggregated data. We're running 60% in general. And I know when we look at CLO equity, obviously we want to drill in more on the collateral, but just as a sort of a generic starting point, things are great right now in the global market. Spreads are tight. There's defaults in the bank loan market. They're certainly there, but things are relatively benign. And I think for us, especially maybe not in the last year, but in the last few years, owning debt has made a lot more sense than buying equity. And we're sitting on our hands with respect to CLO equity. And from, every once in a while, we start looking a little bit more closely to see if we're missing something, how are things are looking. For us right now, we just continue to sort of wait to see if there's an opportunity. On certain deals, we look like we're getting close in the secondary market. We got to traffic through 10 deals to find one that might make sense. On the whole, we just end up being steered away. And that's probably a big result of the lower recovery rate that we've been using.
Yeah, I think if you assume a 60% recovery rate, then it's going to be pretty hard for your equity returns to pencil out favorably when compared to just like a double B. So software loans have been in the news all year. From my perspective, it seems like maybe people are becoming more comfortable with the risk in these loans. It seemed like in February and March, people were very, very concerned. And now it seems like, I talked to CLO investors or CLO managers. They're basically telling me like, look, I have exposure to like 10% software loans. Of that 10%, I'm worried about 1% or 2%. Certainly not worried about 10. And usually the worry is sometimes it's AI related, but often in our business, it's multiple headwinds stacking up to put you in a default because you're lending initially at a 50% loan to value. So a lot can go wrong and we can still get repaid as a lender. That's kind of what I'm hearing from managers and investors. What's your perspective?
The starting point for me is that software as a sector has grown to be the largest portion of the bank loan market. Just as a simple concept, when you see that happening, there's probably going to be some problems there during the next cycle, just as a matter of like thinking. I sort of start there. With respect to AI, as we saw earlier this year, you would look at a deal and it would be the manager name and it would be with the market value over collateralization and then how much software was in there. And everything was very focused on the software exposure. That was the first blush and it was just like everything software is bad. And I think over the last couple months, there's been a lot more of taking a nuanced view. We've had great research come out from some of the banks. We've done our own research. This is an example where we work with our credit team to try to have some way to bracket or bucket the different software names. There's the AI exposed stuff, which is probably smaller than the whole basket, a lot smaller. There's the middle stuff, and there's the stuff that actually might do better with AI. So we've gone through that process and we look at deals. Of course, we know if we're going to sell a bond, the investor is going to look at the software exposure. We're focused on it. My concern personally is more about how big the sector is as opposed to strictly the AI risk. I personally don't really subscribe as much to the gloom and doom about AI and how that might impact different parts of the economy. But specific to software, it's as much of anything as, like I said, of just how big it's grown. It's important to dig beneath that and look at the names. Think about those, not just say, oh, all software is a no-go for us.
So I agree. So at the beginning of the year, it was kind of people wanted to throw out all software, and then it's become nuanced, business by business model, people thinking it through. It seems to me also that as the analysis has become more nuanced, that the business models in CLOs are just showing themselves as more as survivors than not. A couple of reasons, I think, one is that in the investment committees for all the software loan approvals, a big underwriting criteria was just how hard would it be for a business, an enterprise to pull out the software and go with another cheaper alternative. For the most part, the switching costs are very high for the software businesses that were lent to. One, and then the other part of it is that the private equity firms that own these software businesses have expertise in the space. It's some of the bigger high profile names. And they're certainly not sitting around just like waiting to get disintermediated by AI. They have their own playbook and they're trying to, launch new products using AI and increase their own margins. And so kind of the easy stuff, I use AI quite a bit. And there's like a few things where, I don't need a human anymore. That stuff isn't businesses that are in CLOs, fortunately.
I think I would echo most of what you're saying. If you look at new deals put together today, they've pressure tested for the concepts that you're talking about. The few deals, you can think about certain names that maybe there's a healthcare website and everyone's going to start going to your favorite AI tool instead of that website. But for the vast bulk of businesses, I think still in software, they'll be able to utilize AI to benefit. There'll be winners and losers, of course, no doubt. But especially now, I don't remember when this report came out that really sort of shifted everything. I think it was February. Before that, there was one way of thinking. And then after that, things swung hard the other way. And now if you look at portfolios that are put together with software, I think they've gone through the ringer of that analysis, good and bad, exaggerated and underexposed. Now these portfolios probably have the software names in general that are going to have a better chance of making it versus the few that are probably going to be most impacted by AI.
So coming into this year, the expectation was for the Fed to cut and for SOFR to move in tandem. Now the expectation is for higher rates. If we were talking at the beginning of the year, I would have said that SOFR coming down was good actually for equity. Well, it's definitely good for double Bs. That's not for debate, but for equity, I would have said, okay, lower SOFR technically results in lower cash flows from equity because equity is floating rate. However, lower SOFR would also be correlated with lower defaults. And the elevated SOFR has put pressure on companies and their interest burdens. How do you see that? Is equity a winner or a loser if rates stay higher for longer here?
I think equity suffers more if rates stay higher. And if the Fed were to cut, then I think that would benefit equity in general. In an environment where the Fed is easier, you can tend to see tighter credit spreads, which may reduce liabilities, maybe the refi into that. But I think just in general, financial conditions easing is a better environment for equity all around. And then higher rates does at the margin increase the potential for a lot of these companies which are borrowing on floating rate to have more pressure. And it also increases just uncertainty in markets and potential volatility. So I think on the whole, CLO equity probably wants lower Fed funds rate.
So then related to that, the spreads on loans are very tight. If you own the loans just like on your balance sheet outside of the CLO structure, SOFR is like 3.75% roughly, and then the loans are paying a little bit short of 3% over SOFR for broadly syndicated. So we'll call it 6.75 to be generous. One of the rationales I've heard for the kind of the lower spread that lenders are earning is that, well, the base rate's high, so you benefit. So 6.75 is like a pretty good rate for single B credit. But then if you move that analysis to like the CLO, it's not great. You're funding at the higher SOFR. So like for equity, we care about the difference between where we're lending, the spread that we're earning on the assets versus where we're borrowing. And so the higher base rate as the rationale for lower spreads on the assets doesn't really help.
Yeah, I agree. I think for debt tranches, there's many of our investors are yield-based, and so it matters there. I do think that a component of the tight bank loan spreads is the issue we talked about way back in the beginning, which was just that the CLO market is being maybe perpetuated is too strong a word by these fund vehicles, and that's part of it. If you look in general, across all markets, financial conditions are very easy, and credit spreads in almost every sector we look at are near the tights of the last 15 years. So CLOs actually probably screen on a little bit on the wider end versus their historical average versus a lot of other markets. You look at IG and it's, I think, 8 basis points behind its all-time tight. So this is something that we're dealing with, at least at our firm, and I think all credit investors across the board in every sector. It's like there's very little that is actually cheap and everything is at historical tights or close to it.
Over the last week or two, Fitch and Moody's have both come out and said they're looking to revise their modeling standards for ratings. They'll be more or less punitive, actually. So it'll be easier to get for your debt to pass the ratings criteria. How do you think that affects the market at all if those plans are actually followed through with?
As a debt investor, I hate it. What I think we'll see is lower credit enhancement, particularly for triple Bs and double Bs. And I want more credit enhancement and I want more credit protection. I think for equity, it's going to allow structures to be more leveraged, which as an equity investor, I think that they will generally like that. Having been around since before GFC, I don't like the optics of seeing, particularly two companies announce within a week that they're both revising the model. It feels like there's some rating competition coming into the mix. For me in general, I don't like it. And I think it's another indication of this really great product, CLOs, that have had really good performance, particularly from the default side over the last 20 years. And now it's a good thing. So let's sort of like dial up the leverage a little bit more. So I don't like it. It's a little bit concerning. It's certainly getting some headlines. It's marginal, but it's, in my view, a negative thing.
But for the debt, like if we're talking about double Bs, for example, if you look back over 30 years, they have this 25 basis point default rate, which would put it on the corporate scale, and you're somewhere between like triple B and single A. So the double Bs have really outperformed their rating. So in my mind, that would be potentially a reason that you could have less equity supporting the double B. Obviously, that would be negative for the double B investor. But isn't it also the case that investors, 8% equity, or par sub, as we say, in broadly syndicated is where deals usually start their lives. But even if a rating agency would say, okay, we're comfortable with 7%. So the double B is a little thicker and the equity is a little smaller. Isn't it just the case that the investors would just say no? Just because it passes the rating agency criteria, investors make up their own minds what risk they're going to buy. Would it really change anything?
I totally agree with what you said, that investors have the right to make the decision. It reminds me, though, of looking at the bank loan market, which used to have covenants. And over time, many of those have gone away. When you have a lot of different investors, tight credit spreads, demand for certain types of credit product, I think the consensus is it ends up, for better or worse, we'll end up seeing over time credit enhancement levels go down. So I would like to think that investors would say, we still want 8% and we're going to keep it there. but I'm not convinced. I think we have seen like some preliminary structures already come out. I don't know if they're solid yet, but they suggest lower credit enhancement down in the tranche. Maybe they're testing the water. I think it's a wait and see whether investors will accept it. We can just look at junior triple Bs or senior double Bs, as I like to call them. That was a structure that if you're a double B investor, makes the double B a little bit thinner. It's a little worse. It's a little more binary over time. That's the whole market now. Junior triple Bs are in essentially every deal. We personally have never bought a junior triple B. We have a lot of regular triple Bs. We're maybe the only investor in triple Bs that has not done that. So I think over time, if you look at junior triple Bs, maybe there's your answer about what direction we might be headed with double Bs.
I think if the equity supporting a broadly syndicated double B shrank, a challenge for the buyer in that case is that they're already really volatile. The potential of even bigger price swings, given less equity underneath you, I think that would make buying BSL double Bs, at least in the primary, kind of near par. I don't see how that would be a compelling investment for folks.
I would say we're on the same page with that. When things have been good for a long time, I think a lot of investors can get comfortable that what's happened over the last couple of years is going to continue forward, and they might convince themselves to maybe we'll buy some of these, we'll allocate a certain portion of our portfolio, and before you know it, that's the makeup of the entire market. I view it as a negative thing. I'm not sure other investors would agree with me.
Well, I guess the last point, though, is that there's always the secondary market to comp to. If new issue doesn't have the equity subordination that you want, there's a vibrant secondary market with deals that'll be around for years and years, we found. So you can do your investing there, which is kind of the same thing that we would do, or that I would do away from the captives. There's not a great primary market for broadly syndicated equity. However, there's a vibrant secondary market where you can hopefully target returns significantly better.
That's absolutely the case. And that's where we have been doing most of our double B buying over the last couple of years, just because of the slightly thinner tranches. So we've continued to, gravitate. Of course, over time, almost every deal has been refied or reset out of the market. That universe of bonds continues to shrink in years, not in, multiple years, really.
So my closing question is always, describe a CLO in 30 seconds if you're out in a bar and trying to explain it to a friend.
Whenever I talk about structured products in general, I always tell people to think about a balance sheet. And a CLO is no different. It's a balance sheet. You have your assets and liabilities. Your assets are a pool of senior secured bank loans, and your liabilities are the tranches we've spent a lot of time here talking about. And then you have the equity as well, which is the equity that we're talking about. And I think if you think about everything in structured product in terms of a balance sheet, it'll really simplify it. And it's a great way to think about it, whether it's RMBS or CMBS or anything else. It all comes down to being a balance sheet.
Sam, thanks so much for coming on the podcast. Really enjoyed it.
Thank you, Shiloh. It's been great being here. Really appreciate you having me on your show.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.